Good evening. Welcome to another webinar series organized by the Lanka Consulting Group. Before moving on to today's session, let me give you a brief on Lanka Consulting Group. Lanka Consulting Group, or LCG, is an online platform developed to address the consultancy needs of different sectors of Sri Lankan economy. Users of LCG could be both organizations and individuals, and they can visit LCG website to find experts from different industries to match their business needs. LCG works with intentions to address business challenges, particularly small and medium enterprises. Some of the fields that are covered by LCG are business and finance, marketing and sales, HR, manufacturing and processing industry, technology, tax, and startup mentoring. Now you could visit LCG website on www.lankaconsultinggroup.com for more information. Just to keep you updated that this program will be simultaneously broadcast on Facebook as well for the viewers who are unable to get in touch with us via Zoom link. With that, let's move on to today's session, and let me introduce our resource person, Mr. Rohan Senanayake. Mr. Rohan Senanayake is a financial specialist, over 25 years of experience. He is an associate member of the Chartered Institute of Management Accountants of United Kingdom and a fellow member of the Certified Management Accountants of Sri Lanka. Mr. Senanayake has experience in financial markets, including insurance, stockbroking, fund management, and corporate finance. He was the Deputy Chairman CEO of SMB Leasing PLC and Ceylon Merchant Leasing PLC and Head of Investments of Selinco Insurance Life. He was the Managing Director of Orient Capital Limited and also was the Director of Leasing Associations of Sri Lanka from 2005 to 2008. Mr. Senanayake holds a number of board positions, serving in the capacity of Chairman, Managing Director, Director, including Kenagan Investment Corporation Limited and SMB Securities Private Limited. He currently serves as a non-executive director and an investment committee member at Selinco Life Insurance Limited. He is also an advisor and consultant to Orient Finance PLC. So it's over to you, Mr. Senanayake.
On to the presentation, I would like to tell this is not going to be a very technical portfolio management subject. So it's going to be a very practical oriented presentation that I would take you through and some sharing some experiences and some misconceptions that exist in the market. First of all, I would like anybody who wants to ask any questions could send their questions to the chat box, I believe. And during the Q&A session, we can take the questions. So let's look at the first topic, or the topic for the day is if your salary is the only source of income, you are one step away from poverty. I'm sure this topic gives you a lot of challenges to people's mind. Okay, what is Rohan meant by if your salary is, are we near to the poverty? It will be so if you fail to manage your wealth, if a person fails to manage his wealth. So let me go through a very simple life cycle. All of human beings have life cycles. Let me address the life cycle of a finance. How does a human's life cycle or the finance life cycle affect? So you have the first step is virtually the education stage up to about 18, 19 years. Then you move on to the early career stage. That's where you get your first job. Then you go into the career development. You are gradually moving up in your ladder. You are earning more. You are building your family. You are getting into acquisition of wealth, and the second and the third and the fourth are the stages where you really start earning cash inflows to your life, and you come into the peak accumulation stage. This is the later stages of your career where you will be on top of the ladder in the corporate world, and you are earning a substantial amount of wealth, and how you this is where you getting ready one for retirement. Then from there, you start looking for pre-retirement. Now you start thinking about your retirement. Now you look at somebody looks at, okay, I'm good to retire. Then they might take the step from the early retirement, or some might take the step, okay, I need to continue for a few more years and let me work for a few more years and let me move on to this. All these, what we are trying to achieve is what we call the financial independence. Now, financial independence is same is good as that all of us want to be good health, maintain a good health, as well as want to have a good family life. If we can achieve these three, good family life, good health, and good financial independence, I suppose we all can call ourselves as successful people in our life. From here, I will move on to two small theoretical versions. Before that, I want to touch upon what we are going through at the moment. As you know, after a century, near years after a century, the COVID-19 has come and hit us. Not only Sri Lanka, the whole world, and that has led to a lot of unemployment, job cuts, and also even there is no unemployment job cuts, quite a bit of salary reductions, and thus technically your cash inflows are reduced. So with that, people move into what you call reducing their life management. They take certain luxury items out and want to make it more simpler because your cash inflows are reduced. But on top of that, the whole world, the interest rates also have been cut off. That is mainly to give a boost to the economy. There's nothing wrong with that. But if somebody has invested, when I say word invested, there is a slight difference to savings, which I'll touch upon later. If they invested their monies in fixed deposits or bank savings account, that also had taken approximately 50% cut. Before COVID, as you know, the risk-free rate return, that's a treasury bill ratio at close to about 9%, 8-9%. Now it's about 4.6%. So virtually 50% cut on the fixed risk-free rate. But if you take the fixed deposits also, which was around 10, 11 in the established banks and well-renowned banks, the rates have come down to about 5.5%, between 5.5% to 6.5%. So if you had some savings and if you were trying to live with that or to maintain the same livelihood, that also has got into a shock because suddenly it has become 50% of what you would have normally earned. So that is where the importance of how you manage your wealth rather than finding fault with third parties like pinpointing of the government or anybody else that you have not managed your wealth. That is virtually you decide. It's a third person himself decide his destiny of achieving the financial independence. Now I'm going to touch upon two small basic concepts, which is first one I am depicting from a pyramid. First layer, this is you keep in the form of cash or savings accounts or near cash products like money market products, but it's all in savings. Like it's a temporary your immediate requirement. Then you move on to the second level, is called savings, or what you call a emergency buffer. We all would like to have something like if COVID gets hit or something else happen. If you get sick, you need a little bit of more money. So you create a small emergency buffer. I would call it a savings buffer. Then the next level is the investments. Now that is where your excess money or your wealth, where you put your wealth. Now the importance of identifying the savings and investments are the key thing in the success of how you achieve your financial independence. Now differentiating these two is what I see in Sri Lankan market, which have got due to misconceptions, has lost the direction of identifying the two different aspects of savings and investment. Let me touch upon in the next slide when I come into the products which are available. Let's move on to this other small theory, two pockets theory. What does this mean? Now, if you have a dollar, obviously these all theories are in developed in various other countries, and we had used the word dollar. So let me use the word dollar or rupee. If you have 1 rupee, you will first try to ascertain from where did you get this 1 rupee or dollar. If you have acquired by yourself or whether you have inherited. If you have inherited, you will treat this dollar in different manner. You will have a different value attached. Sentiment value would be attached to that dollar because it comes from your inheritance. For example, if you get a house, if you have a land property in Kolpiti, 40 perch property with a house, and if you are inherited from a grandparents, you will want to continue holding it. You will not look at developing because you feel that that's a property you received from your grandparents and you want to keep it. But instead of that, if you have purchased that property from your own money, then the way you look at it would be different. You will really first look at it, okay, I don't need 40 purchase. Let me demolish this old house, construct a house with the same architect, if I like the same architecture in a 10 to 15 perch. The rest of the property I will convert into a yielding asset by either putting up an apartment or something else that where you really get the value for the property and you increase the returns of the asset. Virtually, you are optimizing the values of the return. So this is the two-pocket theory, which I want to just explain. So this is a very important aspect that you need to keep in mind. From here onwards, I would like to touch upon in the available instruments where you could invest in Sri Lanka. Now, we are in a developing country or middle income country. Unlike the developed world, we hardly get most of the sophisticated financial instruments that you could invest. So technically, we have 5 basic products. Other than this, there could be other investment opportunities, but mainly equity, then fixed income, then you get precious metal. Here I'm referring to gold, not jewelry, and mutual funds and real estate. Now, these are the 5 basic assets that you will get where you can accumulate your wealth. So these are the 5 asset categories that you need to balance your strategies depending on your life cycle and your risk-taking ability. Now, risk-taking ability and life cycle, how you should consider these, I will take you through subsequently. But before that, I would like to go through few misconceptions, but on some of these products. Firstly, it's the biggest misconception in equity. Equity in Sri Lanka, I'm referring to here is listed equity, which is quoted in the Colombo Stock Exchange. Okay, that is the biggest equity market in Sri Lanka. I will touch upon the private equity subs later. Now, equity, a lot of people perceive it's as a gambling product. If somebody really wants to move into, they will say, so the society will say, don't put your money in equity. It's a place where only gamblers goes and plays. Because it has been created over the period by the social media, print media, and electronic media as equity as a gambling or where mismanagement takes place. Because you would have seen most of the print media would have carried, whatever the print media carried for the last 10 years in the first page, is if they talk about the stock market, they will only talk about front running, pump and dumping, and mismanagement or front running by the senior directors or employees of the company. So when you, as an average person, when you see these continuously over and over again on the medium, whatever the medium, whether it's a print media or electronic media or social media, you obviously as a human being, you get frightened. There's nothing wrong with it, because that's the right way, that's the right psychology, because you don't want to be a part of all this mismanagement. So I believe that's what this whole thing about Sri Lankan equity market has resulted, where people believe it's a gambling fund. But what's my opinion? If you are wise enough, if you really study the corporate world, and if you have time and if you have the skill set to go through and get a good understanding what's happening, Sri Lankan equity market can be one of the best performing asset. Let me tell you a small true story, not a story, true event. A young guy, I will go through fast. A young guy at the age of 12 or 13, for his 12th of his birthday, his grandmother has asked, what's the gift you want? This guy has said, I would like to get 100 shares of commercial bank. And this has taken place about 12 years, 40 years ago. And the grandmother laughed and said, well, you are too small. You can't own shares. So he has said, no, you buy the shares and keep it under your name. And when I reach age of 18, please transfer it to me. So grandmother said, okay, I will do that for you. So she had bought this 100 shares, commercial bank. And when this guy has reached the age of 18, she had transferred the 100 shares of commercial bank together with some scrip dividends which she had received, or bonuses we call later, because those days it was not CDS, it was, I believe it was all transfer forms, transferred it and give. And this guy today holds these shares with so many bonuses and right issues which he has subscribed, which has a value in excess of 4 million. Imagine a young guy at the age of 12 making that decision, rather than getting a toy, getting an asset which has appreciated so much over the years. So there might be various theories people can put aside. At the age of 12, you don't need shares, you can buy a toy, you can buy a book, you can do it. But your mind needs to be restructured in such a way that you need to start accumulating wealth, which will give you a return in the long term. So this equity being gambling is a fact that people have developed, and certain other institutional who wants the people to save their money or invest with their money with them, they have also developed this concept, equity is a risky market. Let me move on to another misconception, bank debentures and bank fixed deposit. Today, which I really don't understand, banks offer debentures. I'm not going to go into the senior debentures and subordinated debentures. But normally the banks, time to time, to get their capital adequacy ratio sorted out, they offer debentures, sometimes five-year debentures or 7-year debentures. But all those debentures has a interest rate or yield more than the fixed 5-year. If it's a 5-year debenture, it will fetch more than 200 basis points or 300 basis points above the fixed deposit. But the investors or the saving crowd, I would say here the word investor more than investors, would be more comfortable investing in the bank fixed deposit rather than in the same bank debentures. So this is another myth or misconception that people have been. Yes, I agree, there is at a default, the depositors will get paid off prior to debenture holders, but that risk premium or the extra return that you can earn is much better if you can invest in the debentures. But still, people would be comfortable investing on a 5-year FD and receive that interest rather than taking an opportunity and trying to optimize their return in fixed deposits, debentures. So let's go into the next one. Fixed deposits are as investments. Now, this is the common concept. If you speak to 100 people and ask, where is your investments? They will say, all my investments are in banks. My investments are the top 5 banks. So then when I just check with them, they will say, okay, it's very safe. I get a guaranteed return. I don't have to worry. There is no uncertainty. I'm getting a definitely. So they consider this investment on fixed deposit or saving on the fixed deposits as investment, which is to what extent is correct. Now in Sri Lanka, we are seeing for a long time the nominal interest rates have been high and the real interest rates have also been high. But take the present scenario, where even in the month of June, the inflation is close to about 6%, and sorry, 5 point or just 6%, and the interest rates of banks are also close to about 7. So really, are you making an investment, or are you just keeping the money safely in the bank? Is it a safe custody? Is he a safe custodian? I consider putting your money in the banks as fixed deposits as just as a savings instrument more than as an investment opportunity. But this is a common myth. Where is your wealth? It's in fixed deposits. Where? In a bank. So you need to be mindful. I'm not saying that you should not have fixed deposit. Definitely you need to have in your asset allocation basket of asset. Fixed deposit should be there. It should be a definite asset that you should have in the bank. But whether you should have it in all your investments in bank FDs is a question that you need to clarify yourself. So that is something you need to be very mindful, and that is something you need to be ready, because whoever had all their investments in fixed deposit in today's terms, specifically the people who are not earning any more fresh cash or in a capacity of earning new cash flows, they are going through a difficult times because the interest rates have come down by 50%. So you are getting 50% of the cash flows that you received by January, but your cost of living has not come down. It's still rising. So imagine if this interest rate remain at this way, has your investment been a prudent investment? From there, I would like to move into another misconception: superannuation earnings. This is once again another myth. When a person gets into a corporate world, he gets this 20% and 3%, 20% EPF and 3% ETF, and that gets compulsory saved. In the case of a male up to age of 55, it will get saved in the case of EPF. Females, of course, when they get married, they can withdraw it. Once again, they can open a new account, start saving. And they believe this is my investment. If your salary, that 23% becomes only an investment, and where the superannuation funds gives you a return less than the market interest rates or market investment opportunities, how can you consider as an investment? I would consider it as a savings. It is a saving that you are building up to your up to your retirement. So that saving, subject to what's happening, so much of mismanagement and all these bond scams and everything, also get affected by the mismanagement of our superannuation funds, and thereby you lose further money. But there's nothing you could do. That is a statutory requirement. A company, if you are employed in a company, you have to invest that. At least that becomes a saving. That becomes a saving. I would like to repeat, as a savings rather than investment. And when you reach age of 55, you withdraw that savings, and with today's medical systems, you will normally continue to live. Lifespans have extended. If you would be lucky if you go out of this world by 65, 70, then the person will be able to exhaust his savings, the superannuation fund, and continue the simple life. But unfortunately, if the medical system, with the medical system that we have, if you go up to about 80, 90 years, the money what you have received from the superannuation fund will not be sufficient even to enter into a hospital and get a small operation done and walk out. So that's another thing what you need to keep in mind. Yes, your superannuation funds are a saving and it's not an investment, and that will come in when you are 55, but that also need to be properly invested. So superannuation funds are not an investment, and that's not the only mechanism that you should look upon to be ready for facing your retirement and have it to achieve your financial independence. Then I would like to go to prior trends with always will it remain. Now, another example is people look at certain investments and say, okay, this mainly happens in the equity market or sometimes in the real estate market. Certain years, you would have seen real estate in Colombo would have given a substantial return. So people think the same trend will continue. Real estate market will keep on increasing. But whether it will increase at the same pace or whether it will reduce, people believe it happened previously. You know, I bought that piece of land. It has now appreciated. It has given a return of 14% over the last 5 years period. So let me further invest on a further real estate property in the same area, which the appreciation may not be the same due to some reason. That particular area had a super increase on the interest appreciation. That doesn't need to be that you will get the same return. So you expect the same trend will happen. Same thing with equity. So certain people, you see a particular stock or indexes is coming down, and you think, okay, this will be always coming down, therefore I will not take it into the equity market. So this is one challenge that you need to get yourself sorted out, how to address this particular challenge in life. Then the other one is, this is the most important to follow in the high net worth investor. The people like to, that is the nature of human beings, you will like to see a successful person and see, okay, that guy made that investment, he is getting a return, or he bought this particular stock, let me go and buy that stock now. It may be later, but you want to follow somebody's lead. So I think this is also a misconception. You need to be able to make the right decision at the right time rather than following anybody. Because sometimes you have to be careful in the equity market. Sometimes some high net worth investors buys the stocks at a certain price, pushes the price up, and will unload it on the retailers. It has happened in the past, and there's nothing to say it will not happen in the future. So you need to be mindful when you are getting into whether it is real estate or whether it is equity, something you need to be mindful. So these are few misconceptions that I have come across, and there are a lot more misconceptions, but I will not go into most of these misconceptions, but I would like you to consider this misconception before you get into your asset allocations. From here, I'd like to move into a very important topic. How do you do your asset allocation at various life stages? Now, actually, if you look at the first stage, 22 to 35, now this is the stage people like to first develop themselves. So when they have obtained their first degree, they will like to develop their career further advances. You virtually increase your value proposition to your employer. In addition to that, your liquidity requirement is not going to be, liquid assets are not going to be so high, but you have potential to earn. That is, you have quite a bit of time in life to generate fresh cash into yourself. The wealth acquisition starts at this stage. But since you are young, since the funds which are coming in is not so significant, you can and you should start looking at taking a higher risk. Now, when I say a higher risk, it should be all calculated risk. It should not be a gambling risk. It should be a calculated risk. And you should identify investments which would give you a better return. So I would look at fixed real equity, which will have a growth potential to invest, rather than which equities which will be dividend yield. At this stage, you could look at even certain private equity. Now, there I need to be cautions you, I wouldn't recommend you to look at startups. Basically because unless you can add additional value to that startup, if you want to invest on a startup as a passive investor and be silent, a silent investor, I would recommend you to be out of private equity as much as possible, because the failure rate of private equity is very high. But when I say private equity, startup equity, when I say private equity, I'm referring to the well-established companies which are in the growth stage. Most probably 5-6 years ahead, they might get listed, or they have a plan to get listed. So then such companies which have established, which are generating profits, which may most probably have a dividend payout ratio also, which well managed, you could look at in taking some stake of that equity at this stage of life. Second asset category, I would say, to acquire real estate. Now, the challenge that most youngsters tell me, how do we start buying real estate? Because at this age, we can't afford to buy. What we are earning is not sufficient. I agree. But you don't need to buy real estate in the location where you stay. If you're in Colombo 7, you should not look at buying another part. If you can do it, ideal. But look at purchasing a bare land from a reputed real estate agent or from the market at a discounted time or at a bargain price, and settle it over a period. And you can easily allocate some percentage of your cash flow to settle that installment over the period. And the second one, I would say, to consider investing on other categories of like fixed income instrument. Now, when I refer here fixed income instrument, you need to be mindful. What do I mean by fixed income instrument? Be careful considering bank deposits or finance company deposits as fixed income investment. I would say the finance company deposits are well established, well managed. The first 5-6 finance companies investments are safe. But keep in mind the simple theory of Warren Buffett, or where you don't put all your eggs in one basket. Just because you had 10% of your money to be allocated to fixed deposit, don't go and put all your fixed deposit into one finance company or to one bank. But there are other instruments that you can consider, right? Now, that instruments, what you should consider are the corporate debenture market, well rated, Fitch or Lanka rated debentures, which has a rating above BBB. Please do not consider any non-investment grade, even at this stage, because there is a risk of default. And I don't want to, even at this forum, to advocate you to invest on junk or non-investment grade instrument. Even though you could do it and get a higher rate of return, I don't think you need to be mindful, unless you are an expert in the capital market, where you take it and you exit at the right time. So that's, you have to be careful, but you need to have 10% of money in fixed income market also. Now what I'm referring to here is the investments. Can you remember the slide which I showed, the pyramid, where the savings, all these three stages, you will have savings. Your savings, you need to maintain in higher interest earning with the same liquidity possibility, liquidate and obtain to withdraw at any given time that you require. So please consider other opportunities what you have in Sri Lanka, the mutual funds, the money market funds, which are well managed. Look at the money market funds, or even in the same bank. Now, if you have a savings account with a particular bank, if that person goes to the bank and asks, do you offer money market accounts? Then the branch bank manager will say, yes, we have a fixed money market product, and that rate will be about 2%, 1.5%, 2% higher than the normal savings account. But if you move into a mutual fund, which is one of the well-managed mutual funds, or their money market account, you will get about 400 basis points, or 4% higher than the normal savings. But with so much of advertisement and so much of social media and print media and the electronic media advertisement, banks have successfully made their savings accounts so attractive. So all of us are used to go and put our money in the savings accounts, and we believe we have got the best deal. And this is something which you have to be careful, because don't allow any institution or any set of corporates to deceive you where you put your investment. That decision should be made by you, and you should make it with fundamentally with analyzing it, going through and getting the best opportunity that exists. But here, one advice, please stay away from unregulated finance companies, leasing companies, or even regulated risky financial institutions. Because if you look at today, we have seen from 1984, I'm not sure prior to that, up to even this year beginning, so much of individuals has lost their money investing even in regulated finance companies. So please be careful investing in unregulated finance companies, or even in regulated finance companies which do not have a good credit rating offered by a rating agency. It is the advice that I would like to leave with at this moment to any level of investors. Let's move on to the second category of investors, which is how you do the asset allocation. This stage is the stage where you start earning the highest amount of cash flows in your personal life. This is the stage you earn a lot. Same way, there is quite a bit of commitment: children's education, putting up your house, or doing certain commitments in the family. So there's a lot of financial commitment, true enough, but your earning capacity is much greater than what you spend. So at this stage is a very important, you accumulate substantial amount of wealth, and that wealth need to be properly invested. So when you invest at this stage, you need to look at things like, once again, shares, stock market. These are ratios I have given to average person. This ratio doesn't need to be 100% applicable to all, because that depends on the individual risk levels, how much of risk you want to take it, how much of risk aptitude you have, how much of conservative you are. So you might be able to change it a little bit, but you should have something. So you could have about 30% in return. Now you are increasing your fixed deposits, fixed income investment, because you are now becoming mature. Also, you want to have steady income flow, because you'll also start thinking about your retirement. So you need to keep on gradually increasing your fixed deposit. And real estate also, you will reduce your exposure by, it will automatically reduce because you are increasing the other categories of investment. Right. Now, when you want to increase your investment to real estate, the bare lands what you acquire, either you can divest and move into rental yielding assets. For example, if you had bought 2 or 3 blocks outside of Colombo, you can either divest some of them and collect the money and invest in another apartment or a house closer to your place or somewhere where you can convert into a rental yielding asset. So, because from this point onwards is going to be where you are not going to have much earning capacity thereafter, because that is after 55 years. So you need to convert your wealth, majority of your wealth, either cash flow generating assets. Because if you have done that, then even in an event of like COVID or what we are going through, your rental income would have stayed same. So because the rent for the residents didn't come down just because COVID came down. It didn't come down because the interest rate came down. Yes, there would have been a little bit of a stress on the people who are supposed to pay the rental income, but it will not come down as the way to volatility that we see in the interest rates. So also I would like to add that at this stage of life, gold. In Sri Lanka, you will not be able to acquire what you call paper gold, but you can buy gold. Now here, there's a distinction between gold and jewelry. When I refer here, gold is not jewelry, because please do not try to go run and buy jewelry from jewelers and think that you have made an investment. The acquisition of jewelry is not an investment, it's a consumption, because jewelry will have only about 70% gold value. Balance is the workmanship, the profits, or the stones which is embedded, which may not have a second-hand value. But still, you could invest on gold coins or biscuits, and you can take them and you can and divest it, and because you will not attach a sentimental value on those assets. Because if you buy a jewelry, you will find it difficult mentally to go and sell it, because you know this is what you have been wearing, which I don't think I would want to link jewelry to the gold. It's definitely a different product. Now, I also would look at gold as a exchange rate, a product to hedge against the exchange rate risk. Now, 40 years ago, the dollar was 14 rupees. But today, the dollar is 185 rupees. So, same way, the dollar gold prices also drastically increased. Gold is the only product out of this asset portfolio which I spoke as a risk foreign exchange hedging product, which will change positively correlated with the exchange rate movements. So I would consider gold need to be added at this stage into your portfolio. Now comes the retirement stage. This is the stage you will get your superannuation fund, and you will also don't want to have a lot of risk-taking levels. You are moving away from risk, and your livelihood, you want to have a simple life. You don't want to get into complicated instruments, all these things. So now you are becoming risk neutral. Technically, you're moving towards risk averse levels at this stage. Therefore, you will want also the higher liquidity. So when this happens, your investment in fixed deposits will increase over the other assets. When I say fixed investment instrument, fixed interest earning instruments, it will move on. So you will concentrate your fixed income investments to about 65%. You will still hold on to real estate property, which are yielding properties rather than bare lands, because if you hold bare lands, you will want to exit at that stage and convert into fixed income. And you will have some stocks in the listed stock exchange. You will move out of all unlisted equity, because you want cash flow at this stage, because you have no intention of participating and going and becoming in part of those unlisted investments. So you would like to move out of all unlisted investment, either through the listing process or finding a equity finding a proper investor onto those. So at this stage, you need to maintain higher amount of liquidity. So you are now ready for your retirement. So you can easily retire and have a decent life for the rest of your life. And you have acquired a wealth that is sufficient you to sustain for a long period of your life, because you don't have to worry and you don't have to be a dependent on your children or the government to get your medical things sorted out. So that is where the basic concepts of investment. I would like to leave at this moment with few thoughts. I would say, as I informed you, there are 5 basic misconceptions that you need to move out in addition to the misconceptions that I told you. Please identify the difference between the savings and investment. Don't get carried away with the press advertisements or the other marketing materials this institution carries. Please move away from risky assets. When I say risky asset, it is unregulated investment opportunities that are offered. Please be mindful of taking right risk level, risk reverse, and invest without a fear on the proper risky asset at the young age. If you are a young person, if you still have the earning capacity, please go ahead and make some investment on the risky asset, but calculated risk. Finally, which is very important, you need to have a person to support you. If you are not an expert in the industry, in the finance market, like you have your family doctor, you have your family dentist, you have your family lawyer, you need to have your family wealth management advisor. So it is very important in Sri Lanka. Still, we have not moved into that. These wealth advisors have been the definition. The brand has been misused by a lot of institutions. Stockbrokers call them as their wealth advisor. Some insurance companies call them as wealth advisors. Then banks also have now moved into calling wealth advisors. And you have primary dealers calling themselves a wealth advisor. Now the danger is if you go to one of them, they will try to get hold of you into that, all your asset into that category of assets. So wealth. So be careful. Please look into professional fund management entities. Get the advice. Get your personal wealth advisor to advise you, and please do not hesitate. That will go a long way. That's what another final touch I would like to give it to you. That's all for my presentation. I hope that I left some thoughts, you guys, all of you, to rethink your investment strategy and separate from the saving strategy, and how you can build your wealth to achieve your financial independence in life. And I'm sure that if you adopt these strategies, you will have a good financial independence and have a good life in the rest of the life. Thank you very much. Thanks, LCG. That's all from me. I now can take up any questions.
Thank you, sir. Thank you very much. So with that, I think we've come to the second half, or the final half of the webinar session today. So from the audience, we have got a few questions lined up for you. Without further ado, let me take the first question that has been raised. There's a question asking, is it the right time to get into the stock market?
I would say if the stock market is right time to get in, basically you can't, one thing you need to know in Sri Lankan stock market or any stock market in the world, you can't find the exact bottom when to get in. I can't say that. If I can say that, I won't be here. I don't want to be a soothsayer. Neither you can know which stage to get out. But as long as you take a controversial, contrarian theory, you will do well. That what do you mean by contrarian theory? That you get into the market when the markets are down, which everybody starts selling, all become negative perception. You start moving into the market when the markets are negative or on the rock bottom, and you move out when the markets are booming. But really what happens in Sri Lanka or most of the countries, you move into the stock market when the market is peaking, coming to the peak. So you watch everybody else start moving in, you start move thereafter. This is what I said of the misconception of following the high net worth investors or following. So this time, at this moment of time, the Sri Lankan markets are trading at very low price to earning ratios. Certain stocks are trading price to book value less than 50%, specifically certain banking sector stocks, which are very attractive. I think you need to be very conservatively start entering into equity. When you are entering into equity, Anchana, there's another thing what you need to, if you don't have the expert knowledge, don't take the risk you're going and speaking to a stockbroker and giving him the money and ask him, here is the money, please manage it on behalf of me. My advice is to go to one of the wealth management entities. There are established, well-regulated wealth management entities. Please go to one of them. Either invest in one of their mutual funds, or if you have a sizable money, and enter into an investment manager agreement and let them manage it for you. And please keep a close eye what they're doing and have a regular meeting to see what's their progress. And please do not hesitate. If you feel they're not doing well, please withdraw your money immediately and go to another place. So it's a good time to enter into the equity market.
Okay. There's another question, sir. How does someone enter into the real estate market at a young age?
Okay. This is, I believe, we are referring to the early stage of your career. Okay, where your salaries are not huge and you don't have enough cash to go and buy or enough investments to go and immediately invest on a property. As you know, most of these real estate companies offer real estate to pay over a period, but you have to be mindful they charge a high interest rate. But what you could do if you have you have already got into a stable organization, which gives you a stable income, you could go to a bank and take a mortgage loan against it and pay it over the period. And I would say to allocate about 30% of your net salary, what you would get if you want to move into a real estate market, real estate product. So you can do at any stage of your life, but how much you are going to allocate is the question. Unless you have inherited a lot of liquid assets from your parents or at a certain stage where you can go and invest, that's a different point of view, but you can start. It doesn't need to be, if you are from Colombo, you don't need to buy it from Colombo, you can buy from suburbs. If you are in Kurunagala, you don't need to buy from the city, you can go to the suburbs and buy. If you are in like that, you can move out and buy. This is not for your residential purpose. This is to realize your capital appreciation. And at a certain stage, you will move out. Either you will convert into a rental yielding asset if you buy a good plot of land and that particular area has developed over a period of 10, 15 years. And you need to look at those, there are development plans by the government. If you can look at those, and those plans will come true one day. So if you buy one block or 2 blocks down somewhere there, and you should not have all your money in one locality, diverse investing, that's a good investment you should do. And you can leverage and buy it.
All right. So there are a few more questions that have been raised by the viewers today, but I'm afraid we will not be able to facilitate those questions at the moment with the time availability. But what we'll do is we'll give you the answers for those questions through an email in the next few days to come. We'll definitely follow up with you on those questions that have been raised. So with that, thank you very much, sir, for joining us today. It's a pleasure having you. Thank you very much for your insights and experience that you shared among all of our viewers today. And viewers, before winding up, let me remind you that now you could visit to our website www.lankaconsulting.com to book a session with Mr. Rohan Senanayake to get his insights on your business and your professional matters. So with that, we'll be winding up, and before winding up, let me again thank all the viewers who joined us today. Thank you very much, ladies and gentlemen, for your enthusiasm. It's a great pleasure having you. And so, ladies and gentlemen, stay tuned with us because we'll be bringing you more similar, interesting webinar sessions in future as well. So till then, goodbye from all of us. Thank you. Thank you very much.